there's no use for Bluetooth. I was counting on that. Yeah. So firstly, I'm honored that I'm part of this. This is my small contribution to their cause. And when I joined New India Assurance, I met some great faculty from BVKS, and I had the good fortune of working with them, like Mr. Prasad Sakarkar, Mr. Anil Jadhav, Yogesh Zanolekar sir, and even my batchmates, Alok Nimbarunge. So I hope this lecture you find very interesting and it helps you in your exam preparation. So we'll start with the presentation. So this is my screen. We'll just go to the first slide. So, so we'll be talking about fire insurance. Rushikesh updated me that everyone is very interested and looking forward for this lecture. So fire insurance is one subject that everyone is counting on that it will be scoring. So yes, it is scoring, but for that your concepts have to be really clear. And if your concepts are clear, you can attempt any kind of question, whether they are sorry. Hello. Uh, yeah, I hope everyone has muted their mics. And so I'll just let you know that this is going to be a basic lecture from the starting because many of them are the first time attemptees. Many of them are senior to me and they have given many exams and they have far superior knowledge. So if there's anything, I would like them to contribute as well. And the names I mentioned, I know they might be attending this lecture as well. So I hope I give justice to the knowledge you have imparted to me as well. So fire insurance is a scoring subject. Question. Okay. So why the screen goes on? Yeah. So I'll just give you an overview what I'll be covering in the lecture. So first it will be the origin and the basic principles. Like for any kind of insurance, there are some basic principles which have to be followed. Then there will be specific principles for fire insurance itself. All India fire tariff, the different types of fire policies. I think someone has not muted their mics.
Thank you.
Can I mute everyone in this? Rishikesh, where is the option of muting everyone here?
Madam, I have muted all. Now you can unmute yourself.
Yeah, thank you, Rishikesh. So, yeah, so all India fire tariff, the different type of policies, the general rules which govern the fire insurance underwriting, standard fire special policy, the perils which are covered, the general exclusions, the general conditions, and the add-on covers. So this is going to be a comprehensive lecture for these topics. We'll start with the origin of fire insurance. Yeah. So for any kind of insurance, there has to be an origin, like why the need for such insurance was felt. So for this, the origin is the Great Fire of London in 1666. You can remember the number 1666 because sometimes this is asked in the exam. So on September 2nd, 1666, the fire raged for 4 days. And you know, all the underwriting aspects which we take in our day-to-day lives, we ask for them in our proposal forms. So it showed the vulnerability of such a place, like, you know, there were tightly packed houses and there was absence of organized firefighting. So you can remember, like, you know, we always ask for firefighting equipments or how are the situation of the risk we are going to cover. So that was felt that was absent. That's why this fire of London raged for 4 days. You can just imagine the type of destruction it caused. So later on, there were many laws which were passed, and the first instance in the Indian law comes in the Section 2 of the Indian Insurance Act of 1938, which defines the insurance of a fire, the business of effecting. I'm just leaving out that part which I have not kept in bold. the business of effecting contract of insurance against loss by or incidental to fire or other occurrence customarily included among the risk insured against in fire insurance policies. So, as you all know, fire insurance, of course, it covers loss due to fire, but other than fire, there are so many perils which we are covering. So now they have even suggested, they have said that it will not only be incidental to fire coverage, but also to other occurrence customarily included. Those are those 12 perils we'll be talking about. Next, there is this Indian Contract Act, wherein the fire insurance contracts are being governed under this act. So this year, and the act is also important, Indian Contract Act of 1872. Next is they should have some essential ingredients in order to make it enforceable by law. Like fire insurance is a contract between the insured and the insurer. So it should have these five ingredients in it. So they are OCAL. For you to remember easily, I have mentioned a short form for it. OCAL is offer and acceptance, consideration, that is premium. So whenever you receive a proposal form, it's like an offer, like they give you the details of the proposal and then whether it is on us, whether to accept the risk or not. Consideration, they pay premium for that. Then it's an agreement between the parties. Like we always understand whatever are their requirements and according to that, we give them coverages. Fourth, it's the legal competence of the parties to the contract. Like whoever are entering into a contract, they should have that legal right to enter into it. And fifth is the legality of contract. So there are some conditions which always say that you shouldn't deal in illegal substances, and for them, insurance can't be taken. So the fifth part is also important that the contract should have legality, base of legality. Moving ahead, after the basic principles, these are principles of fire insurance which are actually present in all kinds of insurance. So for you to remember, I've just given a small mnemonic sentence that uncle is playing smart cricket politely. So U stands for utmost good faith, I stands for insurable interest, P stands for proximate cause or principle of indemnity. S, and slowly you will come to know what it stands for. So the first basic principle of any kind of insurance contract is utmost good faith. The insured has to declare each and everything which is material to the risk. So, uberima fide. This is also the term which they ask in the exam, like what it stands for. So, normally we say UGF and uberima fide. So, the proposer has to disclose all the facts to the insurer. Also, just after declaring, he shouldn't be very careful, like, okay, insurance is in place, so everything will get covered. He should always act as if he's uninsured. What does it exactly mean is he has to take the precautions that even if there's a loss, he should try to reduce it as much as he can by mitigating it. Like he should take some loss prevention measures as well as loss minimization measures for it. Second principle is the insurable interest. Like why is someone going to insure any property with you? Like if there's a damage or loss to the property, that person is going to face pecuniary loss or financial loss. So that means they have insurable interest in that particular property. That's why they're getting insurance for it. So, like we had that legality of contracts and all, it should also be legal financial interest in the subject matter. Like he should be the owner or he should be associated to the property in such a case that financial loss is felt by him if there's any damage. Also, the insurable interest, unlike marine policies which attaches at the time of loss, for fire it should exist at the time of taking the policy and continue throughout the currency, and also should exist at the time of loss. So throughout the whole policy period it has to exist. That same person will be indemnified. So just as an example, like you come across cases of hypothecation. Hypothecation is adding of bank name or financier in your policy because they have given the loan to the insured. So it is their right to have their name in the policy as well. So like how the person, just like how you take home loan. You have taken home loan and you have taken like the bank is also interested in your property. Like if there's any loss, it is a loss for them as well. So in hypothecation cases, along with you, even the bank has an insurable interest in your property. That's why their name has to be there in the policy. Moving ahead. The third is the principle of indemnity. So, what is indemnity exactly is once you suffer a loss, insurance will only indemnify or, like, make good the loss up to the amount of loss you have actually faced. You can't profit out of this. This is not a business like, you have declared something and then at the time of claim you're earning something more, you're getting something more than what you have declared. So it will be the same financial position before the loss and not in a position of any profit or undue benefit. Will bring you back to the same position as you were before. Also, like that's why it's important to have the sum insured carefully decided at the inception itself. Because once you find a loss and there is, some mismatch in the sum insured, it will be the fault of insured. So you have to always warn them that to select a sum insured appropriately based on your requirement. Because at the time of loss, the maximum indemnity will be the sum insured. Also, the sum insured has to be fixed by the insured. You can advise them, but it's their call to make actually. And the maximum liability will be the sum insured, like I said before. There's one more aspect to it. If there's over insurance, someone feels, their property is worth more. So there will actually at the time of claim, there won't be any benefit to the insured. But the main problem is if he has underinsured it. So there will be underinsurance and the claim amount will be proportionately deducted. Like if the value is like there's an example below, like if the factory is worth 10 crores and he just insured it for 8 crores, that means there is underinsurance. So at the time of claim, proportionately the claim amount will be reduced. So you have to be sure that if it's a property that 10 crores, the sum insured for the policy should also be 10 crores only. Okay, now on what case, like, how can you decide the sum insured? There are different cases. There are four instances, like how different ways in which sum insured is decided. Normally, book value is not used in any of the policies, but just for your information, we have added the point. So first is the market value. Just for an example, you go to sell your old mobile in the market. Like, you'll come to know since it's old and used, you won't get the same invoice price. It will be reduced because of depreciation. That's what market value is. It is also called as actual cash value. This is also asked in the exam sometimes, what's the other word or other term for market value? So that is the present cost of construction of the similar building after deducting from the cost depreciation based on age, usage, maintenance, etc. So depreciation is the key word in this. For any kind of market value sum insured, depreciation will be applicable. Second one, which I was talking about, which is not normally used, is the book value. It is actually an accounting concept. It is the book value indicated in the insured's books of accounts. It is arrived at by applying depreciation on the original cost of account. So this depreciation is the accounting depreciation, not the actual depreciation which we follow in our insurance. The third one is the reinstatement value. This is what which is opted, should be opted, and is normally opted by every insured. Value at which the damaged property can be reinstated or replaced by new property of the same kind without deducting depreciation. That means this loss of that depreciation factor is, removed in this part. You have brought in the same position as you were before. So it is actually beneficial to the insured to opt for this reinstatement value basis policy. That's why you must be hearing whenever we ask them, like stocks are always on market value and building plant machinery are a reinstatement value basis. Like it is, they bring the insured back to the position it was originally in. And the fourth one, some of the items you are not able to find a market value or even, the reinstatement value, because there are sometimes vintage collections are there, like paintings or vintage, what do you say, artifacts. So for them, agreed value basis is decided at the time of taking the policy. So what is agreed value is when there's obsolete machinery or heritage buildings where depreciation, like they are old, but depreciation is not a material factor in them. And availability of similar type of property, because normally even we replace property. But in such cases, you can't replace an old vintage building by, a new building. It has its different value. So at that time, it is agreed by the insured and the insurer that this is the price of the property. So if there's a claim, this much will be the loss amount which will be payable. That's why when you're insuring any property as on agreed value basis, you have to take the valuation certificate. Because how will you assume what will be the price of that artifact or that building? So it is better to get the valuation done and then decide what should be the adequate sum insured for it. So these were the four types of different values, how sum insured is arrived at. The fourth principle is the principle of subrogation. Fourth and fifth are like sister principles, and they are the corollary to the principle of indemnity. So, what is subrogation exactly? Subrogation, if there's a loss suffered by the insured, which is recoverable from third parties who are responsible for the loss, the insured's rights of recovery are transferred or subrogated. Basically, subrogation is like a transfer of those rights to the insurer when they indemnify the loss. So this subrogation is actually in place from the beginning of policy. Once they take the policy, for them, they are only we only matter to them. Like they are only expecting from us. They are not expecting something from the third party because of whom the damage has caused. So for your information, I've given you an example. Like if there's a contractor, due to his negligence, there's some loss. We will pay. We as insurers will pay him, and then we'll recover it from the contractor. First, we'll indemnify our insured, and then we'll sue the contractor. And if there are recovery rights, we'll be taking those. Same thing, like similar, is the contribution condition. It is also principle of indemnity. Sometimes in the exam, they ask like which of the following are the corollaries of principle of indemnity, and they give subrogation, contribution, proximate cause, and different principle. Then these two are the right answers. So here, if the same property is insured with multiple insurers, claim is shared proportionately. Insured can recover only a rateable proportion of the loss under each policy. See, logically, if he has taken insurance from two insurers, he has taken like the example says, with A for 50 lakhs and with B for 50 lakhs. So if there's a fire loss of 40 lakhs, both of them will pay 20 lakhs, 20 lakhs. Like the proportion will be 50-50% only. If there are three, then it will be divided between three, but in no situation will the insured get any higher amount than this 50 and 50, that is 1 crore. He won't profit out of it. He will not get 1 crore 20. Both of the insurers will proportionately settle. So that's why it's called as co-insurance also sometimes. The sixth one is the proximate cause. What it is? The active efficient cause that sets in motion a train of events which brings about a result without the intervention of any force started and working actively from a new and independent source. That's the active efficient cause. Like, you can trace it, you can trace the loss to this cause. And it's also the nearest and effective cause of loss, which will decide the liability. So I've given you two, three examples. Like if the fire is caused by a short circuit, it is insured. So it is covered. But if there is an earthquake, because of which the building collapses and there's fire, so we have to see that whether the insured has opted for the earthquake cover or not. If he has opted for the earthquake cover, then only this claim will be payable. Because the proximate cause is earthquake. Because of earthquake, the building fell down and there was a fire. So here the proximate cause is earthquake, and if he has not opted as an add-on, it won't be payable. So normally in our so the main thing is actually that the practical insurance and underwriting we are doing is different than theoretical. Of course, theory its base is theoretical, but many times we just say okay, flex the earthquake STFI is covered. So we should be careful that earthquake is not inbuilt; it is an add-on cover. So if that is opted, sometimes it's deleted by the insured. So such kind of claims will not be payable if earthquake is not covered. It's not opted by the insured. Third example, that is if there's lightning and because of that there's fire, it is covered. Because lightning is an inbuilt peril of fire policy, SFSP. However, if there's a war and because of that fire takes place, that is not covered because war is a general exclusion. So you have to know what is the peril which is covered and which are exclusions because of which fire occurs, then they are excluded. Then there's this concept of fire triangle, where there are these three components. That is the combustible material, that is the fuel, the oxygen which acts as the medium because of which the loss, it gets the loss happens, and third is the ignition, the heat. So many a times we think there's fire and only the loss because of fire is covered. But there are many other things which are also payable after a loss due to fire occurs. That is the smoke and heat, scorching. Scorching is basically discoloration of walls. You have those black parts, soot covered walls and all. So those are also covered following a fire. Third, falling walls. When there's fire, there's destruction of property. If the structural stability of the building is not great, you have falling walls. Then there's collapse of roofs as well. These all are covered. Okay, if the fire is covered, then all these also become payable. And this is one of the question I've come across in many exams. So just say ki, just see to it that not only fire is covered, even all these factors are followed by a fire are covered. Damage caused deliberately or accidentally by fire brigades in the discharge of their duties. So when there's a fire, of course, fire brigade is going to come and try to mitigate the loss. But when there's a fire, accidentally or deliberately,
We can't listen.
Please wait for 2 minutes. There is a network issue.
hello?
Yes, you
Yeah,
are audible, ma'am.
yeah. Okay. Sorry for the disruption.
PPT is not visible, I think.
Yeah, I'll just share the screen.
Now, okay.
Now, okay, na? So, yeah, we are talking about the damages which are payable following the fire. Next, we come to the All India Fire Tariff.
Ma'am, there's one doubt.
Can we take the questions later? You can just
Sure,
note
sure.
them down
Okay.
at the end, because
Okay.
once we start discussing now, then the lecture flow might just be disturbed. So I request everyone to note down your doubts and questions, and at the end we'll take them.
Okay.
Thank you. So, Sagar, can you please mute everyone? I think someone's mic is on. Hello.
Raju Ramamurthy sir, please mute your mic.
I think Rishikesh, I think you'll have to mute everyone. I'm not able to do that from here.
Done, ma'am, done.
Yeah, yeah. Thank you. So, All India Fire Tariff. So, as we all know, Tariff Advisory Committee, or the short form we always use, TAC, they laid down the rules, regulations, rates, advantages, terms, conditions for the fire insurance business under the provisions of Part 2B of the Insurance Act 1938. This part is also important for you to remember for the exam. So, there was this golden period of AIFT where the rates were fixed for all companies, and like they all used to rate accordingly. But now we as all know IIB rates, and not even the rates, discounting is going on them as well. So, yeah, you should, like, hopefully we go back to those times. This is just a hope actually. So sadly, the tariff was withdrawn from 1st Jan 2007. So the question can be even asked like when it was withdrawn or till which date it was enforced. So 31st December 2006, it was enforced till then, and then it was withdrawn. So when I joined the company, that time burning cost rates were going on. Later came indicative rates. Of course, these are company to company; they are different. But these were the terms which were used for rating fire proposals: burning cost, then indicative rates, and currently we are going as IIB rates. And the new products, like someone mentioned in the comments right now, like now instead of SFSP and all, but SFSP is still in practice, it is still being used. But for especially to cater to the MSME section, that is micro, small, medium size scale industries, the new products like for dwellings, it is Bharat Griha Raksha, BGR, and Bharat Sukshma Udyam Suraksha Policy and Bharat Laghu Udyam Suraksha policies. So Sukshma is for property, which is up to 5 crores sum insured, and Laghu policy is for 5 crores to 50 crores sum insured. So we'll have a separate lecture for this. Today we'll be covering on the stranded fire special perils policy. So there are 8 sections. So there's this table given in the fire tariff, and along with it, just for you to remember this, like there's this mnemonic: good students deal in utilities, storage, tanks, add-ons, and annexures. The first letter of each word stands for the first letter of the section as well. So normally they can ask you, like, from AO to AM, the difficulty level of questions will be a little lesser. They might even ask you, like, this is covered under this section or something. Slowly, the difficulty level will increase as the scale increases. So you have to remember under which section, suppose dwellings and all, section 3. Industrial and all kinds of factories and all, they come under section 4, which is the manufacturing risk. The SFSP policy is in section 2. That you have to remember properly. Like, this policy itself, the coverages, the exclusions, the add-ons, everything is given in the section 2 of the tariff. And the last section 8 is for add-on covers. Annexures are copies of clauses and all which we give along with the policy. Moving ahead. So yeah, like we were talking before, like how is the sum insured arrived? So depending on the type of property you're covering, the sum insured is decided. So for building, it's at the option of the insured. They may even take market value basis or reinstatement value basis. But normally for the insured, reinstatement value basis is beneficial. Then for electrical installation, furniture and the contents, They can be market value or reinstatement value. For raw material of a factory, like it is market value. For stocks, always remember it will be market value. It will never be reinstatement. For stocks, you can't reinstate them back to the original position. There will be some changes, fluctuation in prices. So it will be the cost at which insured can purchase it in the market. Of course, if there's loss, he'll go and try to purchase new stock from the market. So whatever will be the price, he'll get it for. So he has to decide the sum insured based on the current market price of the stock. Next comes semi-finished goods. Semi-finished goods are somewhere, some process has taken place on those goods. That's why the value has increased a little bit for those stock. So it will be market value, that is cost of raw material, where the insured invested his money to get them, and then expenses included up to that stage. Whatever processes he carried out, and those expenses are also included in. And the third are the finished goods. Finished goods are all kinds of goods are, of course, insured at market value. But here it's cost of raw material, all overhead expenses till it reaches the finished goods stage. The main thing you have to remember here is profit is not included in this, because profit is after he goes to the market to sell them. But till now, till they're finished goods, he's just investing his capital, and then whatever processes, that expenses will be covered in this. Then, like I said before, for obsolete buildings and artifacts, works of art, obsolete machinery, there will be agreed value basis. Like we have to agree at a value, like that will be the value payable at time of loss. So the sum insured has to be always fixed by the insured. It should be the maximum of liability, and the rate will be applicable on it. Whatever premium will be charging, that rate per mille rate is always applied on the limit of liability or the sum insured chosen by the insured. So these are the basis of sum insured. Now, once the sum insured is fixed, so there is an option for insured, like slowly if his business is expanding, he can increase the sum insured, or if he is going into loss, he can decrease the sum insured. Like dependent, it's just an example I gave you. So whenever there is an increase in sum insured, it will always be on pro rata basis. This term pro rata is like if for 365 days, this sum insured is increasing, like you're charging a premium for the whole year, annual premium. So for the remaining days, you will charge rateable proportion for that increase in sum insured. If the property is insured for 1 crore today, for the whole year, for 365 days, then after 1 month, he comes and asks for an increase for more 25 lakhs. So that 25 lakhs will be chargeable for the remaining 11 months, because 1 month policy is already over. He is just insuring them for the balance 11 months. So pro rata basis will be those 11 months premium will be charged on 25 lakhs increase sum insured. Second thing is decrease in sum insured. If he comes and he says, I don't want to insure it for 1 crore, now I'm going in loss, I want to decrease it. So decrease will be on short period scale. So short period scale is the scale, the table which is there given below in the presentation here. So what exactly we do is we retain that percent of premium with the company, and the remaining is refunded, because he is decreasing his sum insured. So he will get a refund. But for that, it will not be pro rata. We won't say you insured with us for 1 month, now you will get premium for 11 months. So for 1 month in the table, if you see, it is 15% of annual rate. So it is a small penalty to the insured that he's canceling or reducing the sum insured, like not canceling, reducing the sum insured in between, because he has opted. Suppose we give him the benefit of discount for the annual policy. Now slowly he's decreasing a premium as well. So these different percentages are given whenever there is a decrease. So if you see that after 9 months, he won't get any refund, full rate will be charged. Like we can give him different percentage refund throughout the different periods of the policy, but after 9 months, he won't get any refund. Similarly, in cancellation condition, tomorrow if the insured comes to us and he says he doesn't want to continue the policy anymore. So when he comes and asks, just like we did for reduction in sum insured, we'll give him the refund on short period scale only. So I've given the two conditions. When the insured approaches the company, retention is a short period scale. Like he comes after 1 month, we'll give him 85% of the annual rate, annual premium. 15% will be retained with us. Similarly, when we tell him due to some misrepresentation or non-disclosure of facts, we find out there's a fraud or something, and we are canceling the policy. So when insurer does it, we'll give him refund on pro rata basis. We charge him for whatever days he was on risk with us, and rest of the premium is refunded to him or her. However, there are some cases where we can give even after we are canceling, we can give him the pro rata refund. Oh, sorry, not we are canceling, he is canceling. Let me clarify that pro rata refund of money can be given even when insured is asking us to cancel. So these are the three cases which it can be given. If there is a government order, due to some order, he has to cancel the policy or something, then we can give him pro rata refund because this is something which is not in his hands to, do it. So this is a government order. Or once the building is complete, like normally when there's construction, after a period of time, the building gets construction gets over, and now he comes to us saying, we don't need the policy anymore, so please cancel it. That time we can give him the pro rata refund. Or where the building is demolished, there's no property left to be covered. So whatever premium is there, we can refund it. Actually, there's one more condition where, if he's replacing the property with, he's replacing that insurance with a new insurance for the similar property with us. He's placing it with us only again. So that also we can give him a pro rata refund and then charge the normal rates for the new policy. So this concept, whenever we are refunding, you should know what is the minimum premium retention of the policy. It's like once we go ahead for declaration policy, that's 50%, floater declaration 80%. So you should know what is the minimum retention premium for any kind of policy. That amount will always be retained with the company and remaining will be refunded. Now we are moving to different types of fire policies. So floater policy is a common policy. The name itself suggests floater. Floater is floating sum insured. Like the insured has so many locations that instead of giving individual location wise sum insured to each and every location, he just says there's one specific location sum insured, and this sum insured will be applicable for all the locations. It is usually given to cover stocks which fluctuate between different locations under a single sum insured in a single policy. Instead of taking, suppose there are 100 locations and 100 policies for it, he takes one policy covering all the locations. And for example, he just says there is 10 crore sum insured of stock. It will move from one place to another. So instead of taking separate policies each time, he just insures the policy of 10 crores with us. And this 10 crores will be applicable for those 10, 100, whatever locations he declares. Main point is unspecified locations cannot be covered. Don't compare it with the practical underwriting aspects. As per the tariff and as per the good underwriting practice, unspecified locations should not be covered. He has to give the list of locations to us in advance when he's taking the policy, and only those locations will be covered for us. How is the rate charged on it? So, suppose there is some highest earthquake zone rate. Normally, earthquake zone highest rate is taken and then 10%. Like the policy flex the earthquake STFI rate and 10%. Floater policies, always there's a loading of 10% rate on it. Okay, now one more concept, like if the godowns, insured has two godowns and they're in the same compound. So as per tariff, no floater extra is needed to be charged because they're in the same compound. They'll be just shifted from one building to another. But floater is needed when there are different compounds, different locations. Their floater loading has to be taken. Okay, since this is a facility we are giving to the insured, the main requirement of the like such a facility is there should be good internal audit and accounting procedure under which total amount at risk and the locations can be established at any particular time if required. So at the time of loss, it is very important that the insured is able to substantiate where the loss has happened, what was the stock amount at time, and how it will impact the claim. He should be able to provide all the books and records and accounts. So this is important, an internal audit and accounting procedure. Then comes declaration policy. Like Floater policy had a floating sum insured. Declaration policy is declaration of the insured for every month. He declares the stock is fluctuating. Some months there he has good business, seasonal stock. Some months he doesn't have that good business, so the stock is less. So for to give this policy, the minimum sum insured should be 1 crore or 100 lakhs. So I've written both because sometimes in the exam they ask in lakhs as well. So you should know that 1 crore is 100 lakhs, or they might ask you in crores. So minimum sum insured for a declaration policy is 1 crore or 100 lakhs. And for any one location, the minimum 25 lakhs sum insured should be there. Like if there are four locations and they are like 10 lakhs, 20 lakhs, 30 lakhs. So because of that 30 lakhs, at least this policy can be given because it is more than 25 lakhs at one location. This point now which I'll be reading is very important. Monthly declarations are based on the average of the highest value at risk on each day. Highest value or average is the division, like average is the division of all the number of days and the highest value at risk on each day, or highest value on any day of the month. So it can be either you take the total figure and then divide it by 30 days or 31 days, or you just take the highest day in the month. On that it will be that those declarations will be considered. And when has the insured to be insured has to submit it? Not at the end of the policy. He has to submit it by the succeeding month's last day. Like the next month, 30th day, he has to declare whatever was the stock in the earlier month. If so, what happens if he doesn't declare it? Should we say that there was no stock? No. For us, when the insured doesn't declare it, it is always the full sum insured to be considered. So those who are underwriting in Swiss and all, you remember like there are these columns where sometimes when he declares more than the sum insured, the system itself restricts it to the sum insured which is taken in the policy. And if he declares less, then we can input the value. Less that value, whatever he has declared, we input it in the system. But if there is no stock, insured has to tell us that for this month there was no stock. Suppose it is a seasonal business and for particular months there's no stock, he has to declare it to the company that this month there is zero amount of stock. So that zero will be input in the policy. But if it doesn't declare, we on our own will not be considering it as zero. We'll be considering the full sum insured, whatever he has declared for the policy. And for these three, type of risk, a declaration policy should not be issued. First is insurance for a short period. Like logically, why would you issue a declaration policy so short period? Because at the end of the year, anyways, the months and the declarations are given, and whatever if he has declared less than what he has actually provided the sum insured for, he gets a refund. So you shouldn't give him a short period policy for it. Stocks undergoing process, they will be covered in the asset policy. They will not be covered in the declaration policy. And third is at railway sidings. Railway sidings are these, spare tracks you see in these railway yards and all, where the stocks are kept. So those kind of stocks are not to be covered. Like I was saying, in the refund and cancellation provisions and all, you should know the minimum retention premium. So here, refund is capped at 50% of provisional premium. That is the minimum premium retention. So what is this provisional premium? So I'll just give you an example. So before we go to those top 2 points, see the example. The sum insured declared by the insured is 2 crores at the beginning of policy. We charge him the rate of 1 per mille. 1 per mille is 1 per thousand. So the provisional premium, provisional because at the end of the premium, after all the declarations are submitted by the insured, we'll be finding out the average declaration. And if they are more than the whatever sum insured he has opted, we'll be charging him premium. Or if they are less, sorry, not charging him because the system itself won't accept it. We'll not be giving him any charging him. But if they're less, we'll be refunding the premium. So here he has given the sum insured of 2 crores. Rate is 1 per mille. Provisional premium comes to 20,000. So average of all declarations he has given, like we've come to know whatever is the average, it's 1 crore 60 For 12 months, he gave us the declarations of 1 crore 60. So when you charge the rate of 1 per million on this 1 crore 60, the premium is 16,000. So if you see whatever he has declared is less than the sum insured which he gave the premium to us for. So that is 16,000 and he gave the premium of 20,000. So he is eligible for a refund. So that's why 20,000 minus 16,000, 4,000 is the refund which he'll be getting. So logically, he has paid us more premium than what he has actually declared. So in this policy, if at the time of loss, the last declaration is less than the amount ought to have been declared, condition of average shall apply. Condition of average is under insurance. Like he declared a sum insured of 2 crores here. But ideally, the stock was of 2.5 crores or 3 crores, higher than 2 crores. And there's a loss. We come to know that the stock was higher than whatever he declared. Then under insurance will be applicable and his claim will be proportionately deducted. After that, the premium paid for reinstating the sum insured. So sum insured, once there's a loss, the sum insured is reduced. But the insured should always take a reinstatement of sum insured, as in he should always bring the sum insured back to the original. And for that, the premium is collected from the insured at the time of claim. So here, after the loss, the premium paid for reinstating the sum insured shall not be considered in the final adjustment of premium. So when we are adjusting the premium, like declarations and whatever extra premium he has given, so this premium which is collected at the time of claim settlement is not considered. After floater policy, declaration policy, floater declaration policy. The name itself is like it's a combination of both the policies. There's a floating sum insured, there are many locations, and for every location, there has to be a declaration. For here, just like declaration policy had the minimum sum insured criteria of 100 lakhs and 1 crore, for floater declaration, it is double, 2 crores. And minimum retention, like it was 50% for declaration when you're refunding the premium, it will be 80% for the floater declaration policy. It's a little at a higher end. Next is silent risk. We always come across this term like silent risk. So whenever there's no activity, this is generally for Section 4, that is industrial manufacturing units, and Section 5 utilities. So it is the factory is deemed to be silent when there is no manufacturing or storage for at least 30 consecutive days. So we had come across many situations like these in the Corona period. Like many of the factories were shut down, there was no work going on. So that time, our companies had all they had provided some special arrangement for this, that they will not be considered as like silent risk, and they'll be extended. The occupational policy will be covered for those that period. Then for this, if there is a loss and because of the loss, the factory has shut down, that is not considered as a silent risk because reinstatement process will be going on. So there's a warranty whenever there's a silent risk that during the currency of the policy, the said premises are silent and that no part of the machinery is used for the purpose of manufacture, and that all stocks of whatever nature are removed from the premises, and no part of the premises is used for storage of any goods or merchandise. Normally, if it's a silent risk, there shouldn't be any presence of any stock or any machinery, which, it should be a empty premises. However, still, if the materials are being sold, stored over there, they're not getting sold or anything, then the higher of storage rate and silent risk rate will be applicable. Suppose if the storage rate is, they are non-hazardous goods and the rate is low, and silent risk rate is also given in the list of rates in tariff as well as the IIB rates. So if the silent risk rate is higher, then silent risk rate will be applicable. So either of the higher rates will be applicable. So we move on to general rules of fire insurance. So like normally as practice, we say whatever covers are given to the insured, they have to be agreed at the time of inception. There is no midterm cover. However, tariff had the provision of midterm cover for STFI and RSMD. RSMD is riot, strike, malicious damage. So for it, it's a 15-day waiting period, and insured request should be in writing. Like, today, just a small example, like if it's monsoon season is coming and suddenly you get many requests for STFI addition. So we always put this waiting period condition everywhere. Like, there will be waiting period of 7 days, 15 days, 30 days. Many a times insureds or, these new fresh insurance buyers are in need of insurance only at times where they're expecting there might be a loss due to rains or anything. Then they opt for such covers. Or there's, some political tension and there might be riots or anything, then RSMD cover is also being opted for. So there is always a waiting period to cover these perils. It should be in writing or like mail. Writing is the old term used in tariff. Then payment should be by cash or draft because check and all there's a possibility of it bouncing or if there are any issues. So it's better to collect the premium in cash or by draft, and they can't be adjusted against cash deposit or bank guarantee. So, BG and all is not applicable. You have to pay proper NEFT or cash premium. Then partial insurance concept. Ideally, there shouldn't be any selection of insurance or adverse selection. Someone is covering the premises and they are not covering the building part, only machinery is being covered, or anything. So it is not allowed in fire insurance except the plinth and foundation part. Sometimes only earthquake cover is opted for them for practical purposes. And for machinery, it is not allowed except for boilers. There you can select whether you want to cover them in it or you want a separate policy for it. Kacha construction. This is a term we come across many times in our proposal forms, in our policy underwriting. What is exactly kacha construction is? Buildings having walls and or a roof of wooden planks, thatched leaves, grass, hay of any kind, bamboo, plastic cloth, asphalt cloth, canvas, tarpaulin, and the like. These are temporary structures which will not withstand any kind of peril actually. So that's why it's kacha construction. It's a bad risk for insurers. That's why there's always a loading for these kind of construction, and the rate is fixed at 4 per milli. Even now for Sukshma and all, if you see the calculators which we are given, there's 4 per milli rate charged when you opt for the construction as kacha construction. Then when there is an industrial estate where different occupancies and different factories are there, so there are two options of rating those. One is per se rating. Per se is like depending on the kind of factory or kind of process is being done there, you are rating accordingly. Or if the entire building, if the owner of suppose the industrial unit is taking the policy and building is being insured, the rate as per tariff is 1.8 per milli. So this rate is actually, of course, IIB and all have come up to different rates for the industrial estate as well. But this is the rate as per tariff. Sometimes they ask the kind of, the type of rating which can be done for multiple occupancy industrial estate. So it is either per se or 1.8 for the building. So now we move on to the section 2 of the tariff, that is standard fires and special perils policy, SFSP. So first there are 12 perils, there are exclusions, there are add-ons, and there are conditions in this policy. So perils are basically the kind of causes due to which loss occurs, and fire is a named peril policy. So there are these 12 perils, and only these 12 perils are actually inbuilt covered in the fire policy. So they are fire, lightning, explosion, implosion, riot, strike, malicious damage, RSMD as we call it, impact damage, aircraft damage. STFI, these are just 4 letters, but if you see, the ambit is quite vast for this cover. That is storm, cyclone, typhoon, tempest, hurricane, tornado, flood, and inundation. MTO, missile testing operations. SLR, subsidence, landslide, rock slide. Now, I've written a short form. This is actually bursting and overflowing of water tanks, apparatus, and pipes. Leakage from automatic sprinkler installations, bushfire. So when we had started our careers in the industry, so we are told by our faculty and all to remember it like the short form I've given above, FLARIA, STFI. Sometimes you can develop your own mnemonics, whichever helps you better in remembering these perils and exclusions. So when we say fire insurance covers so and so property and like building is covered and all. So this is actually the subject matter. Like what is the property being covered in a fire policy? So it is any kind of movable and immovable property having pecuniary value. Pecuniary value is financial value. And movable, does it mean that we are covering transit? No. Transit, you have marine policy, but the property can be movable. Plant and machinery, it is movable from premises. So examples are building, furniture, fixtures, household contents, plant, equipment, machinery, stocks and merchandise in premises or in open. So if you go through the tariff, you'll come to know for open there is STFI rates different. They are higher rates because there are higher chances of the stock getting damaged. And in premises, comparatively, the rates are lower. Peril, like I said, it is the specific cause of loss or damage to your insured property. Now, sometimes this question is asked, like, what are the different types of perils? So, there are social perils, which have like human element or societal element, riot, strike, natural perils, which are due to natural occurrences like storm, flood, and miscellaneous types of perils, aircraft damage, impact damage by railroad vehicle, etc. So, these are the three types of perils. So we move on to the first peril, that is fire. The name itself, when you come to, like when you read it itself, fire, any kind of fire is covered. But there are exclusions to it. And also other than fire, like we saw in the slides before, what the losses which are, payable even after fire occurs are also covered. So first, it is of course accidental fire, ignition or burning. Along with that, like we saw before, damage caused by fire brigade person to minimize loss, the loss minimization expenses. Damage caused by water, like, of course, they use water to phase out the fire. Damage caused by blowing up the property. Sometimes you have to blow up the property so that the fire is not spread to other regions. That is also covered to prevent spreading of. Then direct consequences of damage during or immediately following a fire caused by smoke, scorching, falling walls. And the third, of course, property removed from a burning building. So, caused by exposure to weather. Provided, like you can't just say ki it was removed and then it got lost, but the main idea should be, it should be an endeavor to mitigate the loss, to reduce the loss. It should be a loss minimization kind of an act. So the exclusion for any fire loss or fire peril cover is its own fermentation. There are many such substances which catch fire on their own due to their inherent vice. So those kind of substances, their own fermentation is not covered. Natural heating, spontaneous combustion, even spontaneous, sorry, instead of the fermentation, spontaneous combustion, due to their own inherent vice, they catch fire and spontaneous combustion happens. So that is excluded. So whenever you read perils and the exclusions, 90% of the time, these exclusions are going to be covered as add-on covers with additional premiums. So here in this case, spontaneous combustion is exclusion as per the policy, but it can be opted as a add-on cover later on. Fourth point, it's undergoing any heating or drying process. And fifth is burning of property by order of any public authority. So that also we don't cover. So just two examples, like we said, like spontaneous combustion. Like if there's a haystack and it gets ignited and the fire spreads to other haystacks. So if you have ever seen the risk, where there are different haystacks, accumulated in one place. And because of one haystack, that fire is spread to other haystacks as well. So the exclusion, so please listen carefully. The exclusion is applicable only for the first haystack, like the seat of the fire, where the fire actually occurs. Only that haystack is excluded. But other damage, whatever subsequent losses happens, like because of that fire, the walls get damaged, the ground is damaged. Those all are covered. Only that particular haystack won't be covered. Second is the excessive heating exclusion. For sugar, which is undergoing refining process, through the application of heat, like it's a natural process for sugar refining. So if it's damaged by excessive heating, that we won't pay. Next peril is lightning. So lightning, actually sometimes you can see because of lightning there is a fire damage. Sometimes there is presence of fire, or sometimes there's no presence of fire as well. That's why it covers fire or non-fire damage with or without actual also ignition taking place. Flare, so if we completed fire, lightning, now E. E is explosion or implosion. So sometimes these definitions are asked in exams and they interchange them. Explosion definition is given for implosion and implosion's definition is given for explosion. So you have to be very aware of what these terms stand for. So explosion is a sudden violent burst with a loud sound. Explosion, like we normally connote, like for explosion, it's an normal bursting of sound. Implosion is bursting inward or collapse due to external pressure. Like sometimes the articles get, disfigured. Like you can see the metal or something twisted, like it's going inside. So that is implosion. So there's this term concussion damage. I think it was asked in some exam. So what does it incorporate? Broken machinery, shattered glass, splintered timbers, and widely scattered debris. So whenever there is an explosion, so these all are actually collaterals to it. So this happens. So that is known as concussion damage. In this also, there are two exclusions. So what are these exclusions? Loss or destruction of damage to boilers other than domestic boilers. Whenever in exclusion they give other than or exclusion, that means it is covered. So here they are saying in exclusion that destruction or damage to boilers other than domestic boilers. That means domestic boilers are covered, but any boilers other than domestic boilers are excluded. Economizers or other vessels, machinery or apparatus in which steam is generated. So we have a separate policy, boiler pressure plant policy. So, or their contents resulting from their own explosion or implosion. So, whatever happens on their own, that is not covered in fire policy. It is covered under engineering policy for boiler and pressure vessels. And second is caused by centrifugal forces. So, just to simplify it, own explosion is excluded, but damage due to own explosion. Because of that explosion, the premises get damaged, that part is covered. Just like in the fire thing, the seat of the fire is not covered, but subsequent damages are covered, payable. And here, gas cylinder explosions are covered under this section. Next peril is RSMD. I'll just drink a little water. It is going back. Yeah. So RSMD, that is riot, strike, and malicious damage. So they are covered, which are actually direct, visible, physical loss, destruction, or damage by external violent means. Someone is purposely damaging your property, so that is covered, malicious damage. So what is excluded is total or partial cessation of work. Cessation is stoppage of work. So you have these hartals and all. So those are not covered. Permanent or temporary dispossession by order of government or lawfully constituted authority. So you should always remember our insurance will never cover anything which is going against the legal order or government order. So those all will be always in the exclusion part. Permanent or temporary dispossession due to unlawful occupation by any person or prevention of access. Many a time there's a gerav and all, and you are not able to use that property. So that also is not covered by us. And of course, burglary, housebreaking, theft, larceny, malicious act. Which because for burglary, housebreaking, and all, there are separate policies. Whenever there is a product designed to cover these perils, like we have engineering policies for boilers. So for burglary and all, we have miscellaneous products. So those will be covered under those products, but not under fire products. So area R and I, impact damage. So, impact damage covered in fire policy is due to direct contact by any rail, road vehicle, or animal. These are all third party people. By direct contact not belonging to or owned by the insured or occupier of the premises or their employees while acting in the course of their employment. So these all causes are other than insured's own belongings. These are like third party people. So any losses because of the impact damage is covered under this policy. So, like when it happens because of his own impact damage, then that will be an add-on cover. So, like we know, whatever is not covered, many of times it's given as an add-on cover. So here, impact damage due to insured's own rail and road vehicles. Only thing here to be noted is animal part is only for third party, but insured's own animal is not covered even as add-on cover. Next is aircraft damage. So, loss, destruction, or damage caused by aircraft, other aerial space devices, and articles dropped therefrom. So, aerial and space devices mean balloons. You have these beautiful pictures, scenic pictures of balloons. So, if anything is dropped from them and it causes a loss, that is covered. Rockets, artificial satellites, etc. Because when satellites have their debris and if because of that there's a loss, it is payable. However, it excludes supersonic waves. Supersonic waves are pressure waves, basically. If you have seen Top Gun, the way Maverick rides very close to his terminal. So, those are like pressure waves and those will not be covered in the fire policy. So, rattling of window panes caused by aircraft flying really low, like Tom Cruise, of course, and supersonic boom, creating thud due to shock waves causing fissures in multi-story buildings by an aircraft flying at supersonic speed. This won't be covered even as an add-on. This is a standard exclusion. Then comes STFI, storm, tempest, flood, inundation. But of course, like I said before, it includes even the typhoon, hurricane, tornado, flood. So these are basically wind and water related perils if you just observe them. So storm is a severe, if not violent, atmospheric disturbance such as unusually heavy rain. So like heavy rain is there in Mumbai or it's always raining heavily, but it's not violent. If things are getting blown away or something, then it turns to be violent. But heavy rain, hail, winds, snowstorms, or some combination of these. Cyclone and typhoon are examples of storms of greater intensity. They are very violent than even than storms damages. And flood. Whenever there is an escape from the normal confines of any water body, whether it's a lake or it's a river, whenever the water level goes beyond its confines and there's damage, this is all covered in our policy. That is STFI peril covers this. However, the point to be noted here is this STFI is excluding loss resulting from earthquake, volcanic eruptions, and other conversions of nature. So STFI and earthquake are two distinct things. Earthquake, like I said before, it is not inbuilt. So STFI automatically doesn't cover earthquake. Earthquake has to be opted as an add-on cover. And like before, STFI, if it is to be added in between, 15 days waiting period will be applicable and premium will have to be paid by cash or AIFT. Next peril, MTO and SLR, missile testing operations. Of course, these are only, they are conducted by Government of India. No one has a private missile testing operations done, at least we know of. So that is covered. And SLR, subsidence or like going down of the building, like bedding down, on which the property stands, or rock slide or landslide, which are normally happening in the northeast or Himachal regions. So these are all covered, except this question was asked, I think in last year, even in the exam I attempted in 2024. So you can't just know these are covered and these are not covered. They will give you a case study in the exam, like it's a new factory And there's bedding down of the structure. So whether it will be covered or not. So if you read the first point, normal cracking, settlement, or bedding down of new structures. So when you read the question like this, they are giving you some examples. So you should immediately connect it to this point and know whether it is being covered or not covered, whether the damage will be payable or not. Next, the settlement or movement of made up ground. Coastal or river erosion, which is something naturally occurring, those will not be covered. Defective design or workmanship or use of defective materials. This is a human error that is not covered in fire policies. Demolition, construction, structural alterations, or repair of any property or groundwork or excavation. So this is also not covered under fire SFSP. Next is BOPAT as bursting, overflowing of water tanks, apparatus and pipes. The name itself is explanatory. Of course, it will cover only accidental bursting or overflowing. And lastly, there is leakage from automatic sprinkler installation. Nowadays, due to government norms, everyone has to have automatic sprinkler installations or those, those red pipes we have around the dwellings and all. So they are basically any lost leakage from it is covered. However, there are exclusions to that as well. Like if there are any repairs or alterations going on, and then the leakage happens. So it's not naturally or like something happening accidentally. So that is not covered. If there is any repair, removal, or extension, they're extending the pipe or something, that is also not covered. Effects in construction known to the insured, like the utmost good fit part. If he knows there is some defect and because of that leakage is happening, so that is also not covered. So just for you to understand it, there's an accidental leakage from the installation when there is no fire. Like, these perils are not related to fire in any way, but still we are covered. Even if there's no fire or such, we are still covering because there's a leakage from the sprinkler installation. Last is bushfire. Bushfire and forest fire are different. Bushfire is completely like it's a localized, it's a limited event, and which sometimes it can be, like prevented as not prevented, I would say minimized. However, forest fire is catastrophic in nature, and it is like even if sometimes you must have heard of the LA fires, Los Angeles fires. It was a catastrophic event. So if anyone wants to opt for that, there's an add-on cover provision for it by payment of additional premium. They are covered. So example of bushfire is accidental burning of vegetation, grass. Sometimes even the crops are burnt. There's some mixed cropping going on. So that all, if there's accidental, it's covered. But if it is not purpose, it won't be covered. And forest fire is exclusion, but it can be covered as an add-on. So we are done with the perils. We are moving to the general exclusion. Rishikesh, do we need to take any break or such for 5-10 minutes? Hello? Or should I continue?
Please continue, ma'am.
I'll continue. Oh, okay. Yeah. Thank you. So we are moving to the exclusions now. So there were 12 perils. Now there are 13 general exclusions. We are moving one step ahead.
No need, ma'am. Just
So should I
continue.
continue? Oh, okay,
Just
okay.
continue,
Thanks.
ma'am.
Yeah, thanks. So there were 12 perils. Now we are moving one step ahead. So the number has increased, 13 exclusions. So like for every policy, any kind, whether it's fire or marine or miscellaneous, there will be compulsory excess, which is as per tariff or which is decided by circulars and all. So in case of SFSP policy, there is compulsory excess, and the logic behind is to remove trivial claims, to reduce the frequency of small claims, these excesses are given. So first is the compulsory excess. So you have to remember this because sometimes they give you examples and they expect you to know, like if this, the amount of loss, the property at risk is around 100 crores. So what will be the excess applicable? They'll give you the amount of loss and then they'll expect you to know the answer, how much is payable. So sometimes we just mathematically calculate it and proportionately we know under insurance so and so is applicable and we give the amount, but we forget the excess part. So for any fire insurance policy, excess is there. So even when you're calculating loss, excess will be deducted from it and then the final claim amount will be settled. So for property sum insured up to 10 crores, it's 5% amount, 5% of claim amount or rupees 10,000. So these figures, 10,000, 25,000 are the minimum amount which has to be deducted from the claim or 5% of claim amount, whichever is higher. Then excess is applicable per event, per insured, and it is also called. So these are also sometimes terms asked, like compulsory excess or compulsory deductible franchise. Next exclusion is war and allied perils. The name itself suggests, like war, we never cover it. So it is going to be now recently. Many of the companies have launched war covers. Standalone war products are there. So slowly we are changing with times. So now it will be given cover as well. But right now we are focusing on the theoretical part. So as per SFST, war and allied perils are not covered. The nuclear risk is not covered. Both pollution and contamination excluding. Now here again exclusions, condition of excluding means they are covered. So read it carefully that pollution or contamination which itself results from a peril hereby insured against. So if the peril is insured and because of that pollution happens, so that will be covered. And same thing, if any peril thereby insured against which results from pollution or contamination, like pollution contamination happens and the peril itself is covered, then the losses will be payable. Next, fifth point is loss or damage unless otherwise expressly stated in the policy. So if someone has not stated this in the policy, in the proposal form or at the time of placement, so these losses will not be covered. But however, if the person is paying premium and declaring it additionally, it will be covered. So what are these items? That is bullion or unset precious stones, curios, or works of art for an amount exceeding 10,000. Manuscript, plans, drawings, stamps, coins, books of accounts, computer system records, explosives, etc. So the insured has to declare all these items. There's some insured specifically in the policy and give special extra premium for that. And then only these items will be covered. Sixth is loss or destruction of stock in cold storage due to change in temperature. That is due to failure of electric supply. In exams, many of the times they just write FOES and you're wondering where this term has come from. It's in fire or engineering, but FOES is failure of electric supply. So due to failure of electric supply and or fire damage to cold storage machinery following damage due to an insured fire peril. So like I said, if whatever is excluded is an add-on. So this loss or destruction cold storage is an add-on cover which we'll be seeing later. 7. This is an important exclusion which we say electrical risk or the dynamo clause. So here, whenever there is a loss or damage to any electrical machine, apparatus, fixture, fitting, they all are exclusions because of overrunning, excessive pressure, or short circuiting. Even lightning is included in this. But these are all covered in machinery insurance policy, that is engineering insurance. But like we have seen before in previous cases, where the seat of the fire will not be covered. So similarly here, suppose due to some electrical apparatus, there's a short circuit, so that apparatus where short circuit takes place, that won't be covered. But because of that, remaining your peripherals are damaged or the wall is damaged, those portion, the subsequent losses are covered. So just remember this seat of the fire, where the fire actually occurs, that property is not covered. Spread of fire is covered. The eighth point, that is architect and surveyor fees, or in short form, ASCES. So here architect and surveyors, CES is consulting engineers. They are also covered. And debris removal, ROD, removal of debris or debris removal, whichever way you say it. So they are in excess. So in fire inbuilt, they are covered up to 3% and 1% of claim amount. Architect up to 3% and removal of debris 1% of claim amount. So anything beyond that, more than these percentages, they are add-on cover. So like we said, whatever cover in debris removal, these are the aspects which are falling under it. Removal of debris from premises of insured, dismantling or demolishing, shoring or propping. Sometimes the structure has to be re-erected, like to just shore up, to give it some base. So that is also falls under debris removal. So here we have to know that if stocks are only covered, the second and third point don't apply because there's no shoring or propping of stocks. It's only for plant machinery or building. 9. Loss due to delay, loss of market or consequential loss. So how in earlier in RSMD and all, theft, burglary and all were not covered because there are different products for it. Similarly here, loss due to consequential loss is covered in the business interruption or FLOP policy. So it will not be covered under this SFSP policy. 10th exclusion is spoilage material damage due to retardation, interruption, or cessation of any process or operation caused by operation of any perils cover. So when you have these assembly lines and all, when the stock gets stuck, there's spoilage, material damage. So that also won't be covered under this. 11th, loss by theft during and after occurrence of any peril, except if it covered in the riot, strike, malicious damage, inbuilt peril. 12th. So this is the important point here. 12th, exclusion. So in our minds, we always think earthquake is going to be covered in every fire policy. It is not so. It is given in the exclusions part of the tariff. So earthquake and volcanic eruption are exclusions, but they can be covered as an add-on by additional premium. And the last one is displacement of machinery more than 60 days for repairs. So whenever you have factories to be covered, the stock is sent to some other locations and they are known as job workers premises. So they are undergoing some process and then they are being brought back to the company, the factory. So here if they are extended, they are kept in those locations for more than 60 days, then we are not at risk. They are excluded. Till 60 days, it's an inbuilt cover. So we are done with the exclusions. Just brief, run through it. First is the excess, war, nuclear pollution, precious metals, and all those financial instruments. Then the cold storage part, then electrical or dynamo clause, the architect surveyor fees, consequential loss, spoilage, theft, earthquake, and last is the removal for more than 60 days. So after 12 perils and 13 general exclusions, we move on to 15 general conditions. Okay, there is actually 14 add-on covers as well, but then we are moving on to the conditions before we move on to add-on covers. So there are 15 general conditions, and we'll start with the first condition, that is breach of UGF, utmost good faith. So for any contract, if the party is not declaring, the basic material facts to the case, so it is actually not a good practice. So that's why when there is misrepresentation, some facts are not represented properly, they are wrongly represented, or there is misdescription, the policy shall be voidable. Like they have to declare each, and that's why the proposal form is must while underwriting. They have to declare all the factors influencing the risk profile. Second, after breach of utmost good faith, second is if there is fall or displacement of the building, there's a loss, and after expiry of 7 days, unless the insured informs us, policy will be automatically cancelled. And of course, it should be, if it's because of an insured peril, then it's a loss. But other than that, if it just collapses and the insured doesn't inform us, then after 7 days, we are not at risk. Third is the material alteration clause. So insurance ceases to attach if there is change in trade, occupation or manufacture, building is unoccupied for more than 30 days. Like I was saying for silent risk, even here sometimes factories, they are unoccupied for more than 30 days, like during Corona time. Or there is transfer of insurable interest unless by will or operation of law. So here the material alteration clause, unless the insured declares all these things to us, otherwise a policy stops covering those. For example, if there is a death of the insured, so legal heirs are named in the will. So until and unless the legal heirs contact us and they let us know that there is a change in the risk, our policy will stop at that, like, it will stop covering that. Similarly, for bankruptcy proceedings, the trustee or the liquidator will become the insured for us. So just a small example, if the insured's insurable interest ceases, that is if there's a sale of property, he's not the owner anymore, then he's not interested in covering the risk. So the new owner should ideally approach us to cover it. Otherwise, our insurance automatically ceases once there's a sale of property. Fourth general condition is the marine policy clause. So whenever, and marine policy also covers fire damages. So whenever these two policies are simultaneously covering the same risk, the marine policy will always have an upper hand. They will always be the first to pay out the claim, and whatever balance is left, then it will be recovered from the fire policy. So, for example, like, where simultaneously marine and fire will work is, suppose it's storage of goods in port premises. So, there's the duration clause where the stock is come and kept and they're waiting for the truck or vehicle to come and again take it to the factory. So, for that period of that storage, it is either the fire policy also might be covering it and marine policy also. So marine policy will settle if there's a loss, marine policy will settle the claim first and then fire policy will take over from it. Then the fifth point, that is cancellation of policy, which we saw before as well. If it's from the insured, refunded at short period, the table, it will be retained by us. And then if we cancel it, refunded on pro rata basis. We give him like whatever is this due for the remaining part. Only thing is, as an insurance company, we have to give them 15 days notice. Sixth is duty of assured clause. Assured, insured is the same thing. So first part is the duties of the insured. So if there's a loss, what he has to do? Should he wait for the company to come and ask whether a reaction? We read in the newspapers, is there a loss? No. He should immediately notify the loss to the company and submit all the relevant documents within 15 days of the loss. He should not just sit and wait for someone to approach. It's his duty to immediately notify the company. Part 2 is the limitation condition. So herein, when the liability of insurer for any loss is extinguished after expiry of 12 months from the date of loss, unless the claim is the subject of pending action or arbitration. So like I said, if the insured doesn't approach the company itself and there is a huge loss, maybe some procedure or he starts reinstating but forgets to inform the insurance company. So after 12 months, we are not liable. We as insurance companies are not liable to indemnify the loss because our liability ceases there itself. Unless the claim is going on, there are some processes going on, and it is a subject of pending action or arbitration. The seventh general condition is rights of insurer, or right of entry. It is also called as right of entry. So these are two terms for the same condition. So what is right of entry? Suppose there is a loss, the insurer can enter and take possession of the premises without accepting liability. So just because we have gone and visited the site, it doesn't mean that we are accepting the liability. We are not even confirming that the loss is payable. It is just for mere inspection of the premises. And insurer, okay, this is for entry. But if the claim is settled or insured withdraws the claim, we are not allowed to go and enter the premise. So that is also right of entry is restricted. So these are 2 points, two coins of the two sides of the same coin. One is where the insurer can go and check the premises. He has the right of entry. And second point is where he can't go and check or where he can't go and investigate. When he can't go and investigate, when the claim is already settled. So there's no requirement to go and visit the premise. Or it is the insured withdraws the claim. He's not in the mood to pursue it further. So there the insurer doesn't have the right to inspect the premises. After this, 8th point is fraud. So whenever there's a fraud, no claim will be payable. All claim benefits shall be forfeited. That's why sometimes when there is any, hint of suspicion, like some related to claim and the nature of loss, investigation is done. And if fraud is the aspect of, there's a fraudulent aspect to it, no claim is going to be payable. 9th is the reinstatement or indemnity condition. Many questions sometimes are asked between on this and the reinstatement condition at the last part. So here reinstatement condition is the company's right to reinstate or replace the property instead of paying the amount of loss or damage. And insured has to cooperate. Like we as insurance company can either say we'll reinstate or we'll replace the property instead of giving you the monetary value for it. But no, as a normal practice, it doesn't happen. So we pay the loss and the insured himself reinstates his own property. 10th condition on which many sums are asked. So I've given you some examples for it. The condition of average or underinsurance. Both mean the same, average and underinsurance. They are both simultaneously used. So what here happens is if the property at the time of loss is collectively of greater value than the sum insured thereon. That's why it's very essential for the sum insured to be decided properly at the inception. So when there's a loss and the property is collectively of greater value, you declared for 10 rupees and the property is actually of 20 rupees, then under insurance is happening, then insured shall be considered as being his own insurer for the difference. Of course, because insurer will be only liable for the sum insured's limit. After that, whatever is the balance part, insured is responsible for it. And he shall bear a rateable proportion of the loss accordingly. Also, one more point to be noted is every item, if more than one of the policy, shall be separately subject to this condition. So, as per tariff, if there are 4 or 5 items, they are being insured. So, individually also the item should be properly priced, properly sum insured should be taken for those individual items. So, first example is a simple example. The sum insured is for say 30,000. Value is 40,000 actually, but sum insured taken is 30,000. Maybe the insured is not aware or they are not given proper guidance as to what sum insured should have been selected. So at the time of loss, the value is 40,000, higher than what it was declared. And loss is 16,000. Let's say 16,000 normal loss, which is less than the total sum insured. But still, since the declared value is less than what it should have been, the loss is also proportionately reduced, as in the claim amount is proportionately reduced. So how we calculated the loss amount, that is 16,000 into 30,000, that is sum insured divided by value of property, the actual value. So 16,000 is divided, is multiplied by 3/4, 3 and 4, whatever is the proportionate payable amount. So he is eligible only for 12,000. So 3/4 of 16,000 is 12,000. So he will not be paid 16,000 completely. He'll be paid only 12,000. Just to go further and deeper into that concept, like we saw, if there are more than one property is covered, like more than one parts to that same insured property, then individually also the values have to be correct. So here if you see, the sum insured declared is total of 9 lakhs. Individually bifurcation is given, building, machinery, stock wise. But after at the time of loss, it is found out that the value of machinery declared was higher, 3 lakh, and value is less. So that is fine. Over insurance is anyways fine. At time of loss, whatever he is eligible for, he'll be getting. But stocks amount declared was less. So sum insured of 5 lakhs, but value is 6 lakhs. So when there's a loss, so loss is also proportionately, reduced. So instead of 60,000 loss, he is only eligible for 50,000. Total sum insured is same, but individually, even the items sum insured should be properly decided. So here the losses amount payable is proportionately reduced. On to next condition, the contribution condition. Like we saw this in the principles of insurance, contribution, and subrogation. So those are also the standard conditions in the fire policy. So contribution condition says that if there is more than one policy, more than one insurers, the same property and covering the same property with similar peril, then in event of loss, company will be liable to pay only the rateable proportion of the loss. So New India and National are in co-insurance terms having covering some one particular property, and it's 30-70 ratio. National is suppose the leader. So at the time of loss, the insured will be paid in that same ratio only, 30-70. He will not get higher than those, whatever the amount is. Then the 12th, subrogation condition. Insured's rights and remedies to obtain relief or indemnity from other parties are subrogated to the insurers, like we saw earlier as well, who are entitled to these rights even before they indemnify the loss. Is these rights are automatically these rights are automatically transferred to the insurer once the insurance contract comes into place. So whenever there's a loss, we indemnify our insured first and then go for the recovery rights, the subrogation rights. 13 point, arbitration. Many times questions are asked on this part as well. So basically arbitration is only to decide on the quantum of the claim amount. So if there is any dispute on difference with related to quantum, or that is the amount of loss, then they go into the arbitration process. So what happens is one sole arbitrator is to be appointed by suppose the insured and the insurer. However, sometimes we don't agree to the sole arbitrator. Within 30 days, if we don't still agree, then they shall be referred to a panel of 3 arbitrators. So if one is not being agreed to, then we'll all select, each one of us will select one arbitrator, and both of them will select one third arbitrator, which is agreeable to both the parties. The parties cannot agree upon a single arbitrator within 30 days. There's a timeline to it. Of any party invoking arbitration, the same shall be referred to a panel of 3 arbitrators, one to be appointed by each of the parties, and the third arbitrator to be appointed by such 2 arbitrators. Means as parties will appoint our own arbitrator and they themselves will appoint a third one. So in total, 3 arbitrators will be appointed. And the third one will be called the umpire, like in cricket. So this arbitration is governed by the Arbitration and Conciliation Act of 1996. So Insurance Act, Contract Act, and Arbitration and Conciliation Act. All these acts, wherever they are mentioned, in, especially your III books, just have a look at them and remember those years and the sections. And the 14th condition is written communication. Of course, nothing is said verbally and agreed to. Like we can't agree to a risk verbally. Same thing, if there's any notice or communication to the company required by the condition, it must be written or printed form. And the last is the reinstatement of sum insured. So the earlier reinstatement condition is the insurer's right, how they want to reinstate the sum insured, by cash or by reinstatement of property. Here, the reinstatement of sum insured condition means that the sum insured should be maintained throughout the currency of policy. So what it means is, suppose there's a loss. Suppose from 10 crore property, there's a loss of 1 crore. So ideally the property is going down to 9 crores. But it is a condition that they have to reinstate the property. So after few months or days, whatever, the property will be reinstated back to the original form. So we are assuming that that 9 crore will again go back to 10 crore. Just for example, I'm saying 9 crore is going to go back to 10 crores. So for that balance, whatever is that reinstatement of sum insured, we have to collect the premium from the insured at the time of claim settlement. So the condition states that specifically, full sum insured has to be maintained throughout the currency of policy. Upon the settlement of loss, pro rata premium from the date of loss to the date of expiry shall be payable by the insured. The extra premium shall be deducted from the net claim payable. So instead of collecting, the claim amount will be settled, will be minus that premium, whatever is going to be charged for the balance sum insured. So we are done with the 15 general conditions, 12 perils, 13 exclusions, 15 general conditions. Now we'll be moving to the add-ons part. That will be the last part of the lecture. And a few clauses. Some free clauses are also given in the policy. policies. So we'll be just going through them as well. So 14 add-on covers. So they all are in line if you see 12 perils, 13 exclusion, 14 add-on covers, and 15 conditions, if you are able to remember them like that. So what are these add-on covers? I'll just quickly run through them and we'll see at them individually later. The first is spontaneous combustion, what we saw in the fire peril, which is covered and what is not covered. So exclusion is spontaneous combustion, it is covered in the add-on covers. Second is earthquake, the most important one. Fire and shock. So I've seen in private companies, their policy documents mentions it as earthquake and in bracket fire and shock. Third is forest fire. Like bush fire is inbuilt, but forest fire is exclusion, but covered at add-on premium as an add-on cover. Fourth, impact damage due to insured's own vehicles. Third party impact damage is inbuilt, but own is add-on cover. Fifth, deterioration of stock. Fifth has two parts to it. 5 is deterioration of stocks in cold storage due to accidental power failure consequent to damage at premises of power station due to an insured peril. It is due to damage at the power station. It's a third location somewhere. It's not declared in, it's not our insured's location, but the power station location. And B, deterioration of stocks in cold storage due to change of temperature arising out of loss or damage to cold storage machinery in the insured premises due to operation of insured peril. Because of the damage to the machinery, the cold storage stock is getting damaged. So that is covered as an add-on cover. Fifth, sixth is architect and surveyor fees in excess of the 3% and debris removal in excess of 1%. Inbuilt is only up to 3% and 1%. Add-on is excess of 3 and 1%. 8. Omission to ensure addition, alteration, or extension clause. Spoilage, material damage cover. Leakage and contamination cover. Temporary removal of stocks clause. Loss of rent clause. Insurance of additional expenses of rent for an alternative accommodation. And the last is startup expenses. So we'll be going step by step. So first add-on is the spontaneous combustion add-on cover. It is only in respect of fire damages as a result. There might be other kind of damages, but the damages which we'll be covering due to spontaneous combustion is the fire damage. So the premium is charged on the relative combustibility. So these spontaneous combustive articles are, they have that inherent spontaneous combustion ability, like they have a combustibility factor to it. So based on that, our tariff has segregated them into 4. There are 4 categories. So the first one is low or non-existent. They are very in extreme rare, like, they need very high temperatures to combust. So for them, the rate is really low. You can remember these rates. Sometimes they might ask you, at a lower scale level, they might ask very simple questions. For this, what is the rate? So low or non-existent rate is 0.25. Then slightly moderate, variable, and highly susceptible to spontaneous combustion have high rate of 1 per million. So for relative combustibility, the category 1 is the lowest, 4 is the highest. For earthquake, it's the opposite. For earthquake zones, 1 is the highest, 4 is the lowest. So this also in your mind somewhere just note it down. Like for spontaneous combustion, for category 1 to 4, low to high. For earthquake, 1 to 4 is high to low. And even for storage of storage risk, section 6, low to high. Category 1 is low, category 3 is high. It has 3 categories for storage. Category 1, there's non-hazardous category. Category 1, hazardous goods. Category 2 and category 3, which is the highest. So you can remember that category of storage and spontaneous is similar. Only storage has 3 categories and here it has 4. So in the tariff, it is said that mere charring. Charring is like blackening of the material or, not burning, but it turns black, sooty. So that charring of the property is not covered. And the sum insured is the sum insured of that relative group. So when you take an add-on in the policy, it's not the complete sum insured, the total sum insured. For this, it will be only sum insured of that combustible, spontaneous combustible property. So only the stocks. And among stock also, whatever is prone to spontaneous combustion, insured normally opts for that sum insured. Next add-on is earthquake. Earthquake can cause, because of earthquake, landslide, rock slide, flood, overflows of sea, lakes are also caused. However, sometimes earlier there used to be, there still is, of course, for practical purpose, insured has the option to delete STFI. Then here, if the insured opts for deletion of STFI, then flood group of perils, if flood group of perils, flood, inundation and all, due to earthquake are not covered. So, earthquake and STFI are two independent factors. So earthquake clause does not cover STFI perils, and similarly STFI perils clause does not cover earthquake. However, when there are tsunami damages, tsunami is basically earthquake in the ocean or the sea due to which there are tidal high waves and then it causes destruction to property on land. So if tsunami damages are to be covered, insured has to opt both for earthquake and STFI covered. So this is a favorite question of the examiners. They always ask on tsunami. So earthquake, fire and shock cover in conjunction in STFI is essential to cover tsunami damages. So like I said, for the spontaneous combustion, how they have from low to high. Similarly, for earthquake zone, zone 1 is highest. Normally, these are the northeast regions and Kutch region and all. They are in zone 1. And zone 4 is the lowest, where there are low occurrences of earthquakes. So after compiling many years data, the zones are decided and they are given in a tariff state-wise. So zone 1, for earthquake zone 1 is highest and zone 4 is the lowest rated. So for earthquake, it's the total sum insured to be taken for charging earthquake premium. For spontaneous combustion, it was only the relative commodity sum insured, but for earthquake, it's the total sum insured. The next add-on cover is forest fire. Bush fire is inbuilt peril, but forest fire is add-on cover. So this extension includes loss or damage to property insured directly caused by burning, whether accidental or otherwise, of forest, jungles, and clearing of lands by fire. The rate of premium is determined subject to 5 years claim experience, discount, or loadings. And it is the specified sum insured. This you can opt, like forest fire, if you feel your damage will be restricted up to a particular sum insured, you can opt for that sum insured. Premium will be charged only on that. Then next add-on is impact damage by own. This is not the third party one, which is covered as inbuilt peril, but this is the own damage. It covers loss, damage, but direct impact to insured's property caused by insured's own power-driven vehicles, forklifts, cranes, stackers, and or caused by articles brought therefrom. Whatever is due to insured's own actions, that impact damage is covered. However, the point to be noted here is does not include loss or damage due to insured's own animals. For the perils cover, it was given that third-party animal impact damage due to third-party animal are also covered. But here, insured's own animals are not covered. And the sum insured on which premium is charged is the policy sum insured. Sometimes, for practical purposes, they opt for 5% of BMA. But as per tariff, the whole full policy sum insured is to be opted for this. Next is omission to insure, addition, alteration, or extension clause. Sometimes the insured is not able to completely provide the final sum insured. Some part is left out, or they're in the process of acquiring some new properties, and maybe later on they will inform it to the insurance company. So this clause is also opted by the insurer. So new additions to building or machinery to be declared, and then premium is adjusted, additional premium is collected. However, if the insured fails to declare at the end of policy period within 30 days,
there shall be no refund of premium. Suppose there's he over-insures it and then he fails to declare that, okay, this building was for so and so sum insured, but actually it's only this much. So there won't be any refund for it. And policy rate is 5% of BM. It will be only covered on 5% of BMA's building, machinery, apparatus, or accessories sum insured. Premium is charged on that. And DOS, deterioration of stock. DOS is a short form. Due to accidental power failure consequent to damage at the premises of power station. Like I said before, it is not in the insured's own premises, but at the premises of the power station due to an insured peril. So only among those 12 perils, if it happens, then this add-on cover is given. It is caused by change of temperature. First is in consequence of failure of electric supply at the terminal ends of the electric service feeders from which the insured obtains electric supply. So not from any, but from where this insured is deriving its electric supply, and directly due to damage caused by any peril insured against under this policy to property at insured premises or any electric station or substation of public electric supply undertaking from which insured obtains electric supply. So ultimately, insurable interest is of the insured. He is going to suffer the loss. So he takes this as an add-on cover. However, we have to note that the loss will start only if after it exceeds 24 hours. So till 24 hours is like then excess for this add-on cover. Only after 24 hours, our liability checks in. Like I said, FOE is failure of electric supply. However, we have to note that just lack of power without any peril, just, there's no electric supply. That is not covered. Some insured peril has to have acted upon on that in premises, then only this add-on cover operates. Next is deterioration of stock due to change in temperature. These are all related to change in temperature, but due to different factors. So that was at the power station. Here it is due to loss or damage to cold storage machinery in the insured's premises due to operation of insured peril. So always remember, only if it's an insured peril, then these losses are going to be covered, whether it's at the third-party power station location or at the insured's own premises. So here, operating peril may have not caused the direct damage to stocks. That the damage to the stock is not directly happening. The perils are not acting directly on the stock, but on the machinery that is processing the stock or storing the stock. So damage to stocks may be due to change in temperature because machinery maintaining the temperature has been damaged. So of course, these are cold storage premises. So if the machinery gets damaged, then this add-on cover covers the damage to stock. Duration of each such failure should exceed 24 hours, like it was there in the previous slide as well. It has to exceed 24 hours, then our liability will kick in for this. Damage to those machineries and all will be covered in the DOS policy, engineering policies. Next add-on is spoilage material damage. It covers material damage by perils causing spoilage, that is loss of stock in process, damage to machinery, containers, and equipments, including cost of removal of debris and cleaning. Sum insured is value of stocks in the specified blocks. Spoilage of stock or machinery should occur due to retardation, interruption, or cessation of process in the insured's premises, which is damaged due to an insured peril, and liability is admissible under the policy. So somewhere the fire happens in another part of the factory, but because of that, this whole process is disrupted, and whatever stock is there under process, it gets damaged. So this add-on cover will cover that kind of loss. Next is leakage and contamination. So as the name itself suggests, leakage and contamination is only for liquids, that is oils and chemicals. Leakage from container by accidental means, and accidental contamination by contact with foreign matter. Sometimes this also can lead to explosion also. This is very particular for these oil and chemical factories. So these, of course, the liquids will be stored in tanks. We have these huge oil tanks in port premises or maybe some designated premises where these oils or chemicals are stored. So as a practice of rating, when the tanks are within premises, the rates are lower, and when they are located outside premises of the insured, the rates are higher. And also we have to note that contamination should be accidental. Any kind of loss should be accidental. But due to contamination due to improper handling, that there are specific set of rules for handling of such substances, and those are not followed and improper handling is done, then these losses are excluded. Then the add-on of architect, survey, consulting engineer fees in excess of 3%. So after 3%, there's a limit to it. They will be restricted at 7.5% of the loss, and does not cover cost in connection with the preparation of insured's claim or estimate of loss in the event of damage by insured's bill. So what basically this does is, it doesn't pay for claim preparation cost. That in nowadays we are giving as an add-on cover, but not under SFSP policy. It will only cover the architect fees. It will not cover the cost of preparing the claim or documentation. Then rate charged for this is the policy rate. Whatever you charge for the policy, the rate is charged same for this add-on cover. Similarly, for removal of debris in excess of 1%, it can be covered up to 10% of claim, and the policy rate will be charged on the sum insured. Next is the temporary removal of stocks clause. So 10% of sum insured for fabricating or processing. That is the job working clause we saw. So that is covered under this add-on cover, and a pro rata condition of average. So whenever after those 60 days, still stocks are kept at others' premises. So instead of that inbuilt cover, if you have opted for this add-on, this will be covered, and the sum insured is restricted to only 10% of the stocks you have. And pro rata condition of average. So if your declaration of stock value is less than what they are actually are, under insurance will be applicable and loss will be proportionately payable. And loss of rent clause. This is actually applicable for the owners of the house. So whenever the building or any part is unfit for occupation, in consequence of its destruction or damage by perils insured, by insured perils only. If there's any loss and the building gets damaged, it's not, it's not livable. You can't stay there. Then alternate, you're looking for alternate accommodation, and here the owner of the house is losing out on the rent. So he will take this add-on clause of loss of rent. However, it should be noted that the alternate accommodation should be in the rent, as in it should be in the same city, because then similar pricing will be there. Owners is, of course, it has insurable interest in content and building it's also, and the tenants only have insurable interest in the contents. They are not the owners, so they won't take the building insurance for it. Maximum, this sometimes is asked in exam. The maximum indemnity is 36 months or 3 years, and minimum has to be 3 months. Then insurance for additional expenses of rent for alternative accommodation. This is normally opted by the tenants, and it is for non-manufacturing premises only. So non-manufacturing can even be offices, not only dwellings. It can be offices also. Sometimes you have to shift your office to some other place because there has some loss occurred. So here this add-on cover will cover the same. It should be like earlier slide. It should be in the same city or town. Tenant will request cover for the contents. Owner occupant will compulsory cover the building and contents part. And maximum indemnity for this as well is 3 years, 36 months, and minimum 3 months. The last add-on cover is the startup expenses. Following a loss, the factory or the premises is shut down. So for it to start again, there will be some expenses which will be undertaken by the insured. So this add-on cover will take care of that part. The policy to cover startup costs necessarily. Just because they're starting up and they're including some extra costs, that won't do, which are necessarily required to start the industry and reasonably incurred consequent upon loss or damage by the policy. And here the insured has to mention the specific sum insured. Premium will be charged on that, and accordingly this add-on cover can be given in the policy. So we are done with the add-on covers part. So there are these 2 or 3 clauses which are remaining. We'll just go through them and then we can finish up the lecture. So escalation clause, Sometimes it's even mentioned in the add-ons part, but actually it's a clause. Escalation is somewhere in future the price is going to increase. That's why you opt for this clause. So it is applicable for building, plant machinery and accessories, not stock. Stock has fluctuating price. So that is escalation clause is never given for stocks. It's only for the fixed assets of the policy. And maximum escalation. So you can't say ki escalation I want 100%. That means you're underinsuring. Basically, it means you're underinsuring your property. So it is restricted to 25%. We are giving the benefit of doubt of 25% to the insured. So escalation can be opted for 25%. Premium is to be charged at 50% of full rate escalation sum insured. So suppose your escalation sum insured is 40 crores. So if your policy rate is 5 per mille, for those 40 crores, you charge half of that 5 per mille, that is 2.45 per mille. So basic logic of this statement is premium is to be charged 50% of the policy rate on the escalation sum insured. Then there are few extensions which are, there's no premium charged for them. They are just inbuilt, or you can the insured has to declare it. Like he or she needs this extension for the policy. So first is the reinstatement value clause. So reinstatement, like bringing the insured back to the original position, it has 4 provisos. So reinstatement value, when it has 4 provisos, so these 4 provisos or provisions are like work of reinstatement must be commenced, that it should begin within reasonable and with reasonable dispatch and completed within 12 months. So it should begin and complete within 12 months of the loss. If carried out on other side, sometimes at the same premises it's not possible to re-erect the building or re-erect the factory. Sometimes it takes place at some other location. So that is agreed by the insured and insurer together. So if that happens, the liability will not increase. Whatever sum insured was opted earlier, same thing will be payable to the insured for the different location as well. Second proviso is, until reinstatement is not carried out by insured, liability shall be restricted to normal indemnity basis. So till the time he reinstates and then submits the bills and all, till then we are liable only for the normal indemnity. Then we can decide whether it's market value or reinstatement or whatever he has opted for. Third is the condition of average. So of course, at the time of loss, it will be checked whether the property insured was rightfully the sum insured was rightfully taken or not, or whether under insurance is applicable. And the last point is reinstatement settlement shall not apply if the insured fails to intimate his intentions. So like earlier we had seen, if he doesn't intimate the insurer regarding his intention to reinstate within 6 months, reinstatement value clause is foregone, and also the liability of the company will not be applicable here in such cases. So these are the reinstatement value clause. Reinstatement conditions are different. Reinstatement value clause is different. Then local authorities clause. It is an extension of reinstatement value policy. So many times this question is asked. It is an extension of what kind of policy? So it's a reinstatement value policy extension. The amount recoverable under this extension shall not include, of course, when it's a government regulation or all, just so that insured is taking some extra efforts and paying some extra charges or anything, those all will not be paid. So like it said, the cost incurred in complying with any regulation or bylaws, you should have ideally done it before itself. But since you're doing it now, that is not payable. The additional cost that would have been required to make good the property damage, the amount of any rate, tax or duty or other charge, and for same provisos which were there for reinstatement, those will be applicable here as well. Then designation of property clause. So designation, the name itself says ki whatever you have designated that property as, whatever you have named that property as in your books, that will be treated the same as by the insurer. We'll consider whatever the insured has designated the property as in the books. So insurers agree to accept the designation under which the property has been entered in the insurer's books. So practice varies among insureds as regards classification of items of property in the books of account. So many a times, whatever is the layman terms and the actual industrial practice terms might be different. So whatever the insured decides, we'll take his word for it. Just an example, a compound wall may be treated as part of plant value. So many a times, some of them declare compound wall as a separate article other than superstructure and all, and some of them consider it in the superstructure itself. So naming can be different, but value has to be declared by the insured. Similarly, air conditioner may be classified as machinery and not electrical machinery. So maybe they can take in plant machinery or they can consider it in the electrical apparatus. So whatever name they suggest for us, we accept it. The clause clarifies the position in order to avoid any disputes on the issue. Sometimes at the time of claim, then we can say, to check the under insurance part or anything. That time it has to be seen whether this clause is opted. Because then insured at the time of loss can't come and say, okay, this was covered under this heading and not under this heading. So he has to opt for this clause. Nowadays, it's normally there in all policies. But as per the tariff, this is a clause which has to be mentioned by the insured specially. Then this is the last clause, contract price insurance. It's applicable for the imported goods only. Like the price is already agreed between, it's already goods are sold and they're in the insured's premises waiting to be dispatched and there's a loss. So we agree to whatever price was decided by the contract. We agree to pay that kind of loss. So it is insurance of imported goods only and not for goods of local manufacture. Contract which is cancelled either wholly or to the extent of loss or damage is subject to the contract price clause. So yeah, these were the basic concepts of fire insurance, which I thought of just informing you all today. And I think we are done for today. I'm really grateful to all of you for listening to me patiently. And it was a very good experience because for me, I thought I'll try to make this a comprehensive presentation and try to highlight the points which are normally asked in the exams. So of course, your triple I books and all the BBK's previous lectures, because I myself used to refer to these lectures, and the faculty is really great. I remember listening to Geeta ma'am's lecture, Avdut sir's lecture, and also, so these are our role models. So I'm just doing my bit to help you all further and for the exam preparation. There are still 2 more weeks remaining, so read your triple I books really well, understand the concepts, and try to make questions on your own and see what combination of answers, because nowadays there won't be straightforward question answers. There'll be statements you have to guess which are true ones, which are false ones, but the basics remains the same. You have to know the concepts really well. You can opt for any kind of combination of answers questions later. Yeah, so that's all from me for today. Thank you so much. I think Rushikesh, if anyone wants to ask any questions or any queries, if you want to continue, we can, or it's already more than 2 hours now. I think everyone must be waiting for lunch. You can just drop the questions on WhatsApp or something and we can answer them.
Share the notes, madam. This.
Yes, sure. I'll be sharing this presentation with you.
Thank you. Thank you.
Madam, can we ask question?
Yes, please.
Madam, you told debris removal add-on is on claim amount. I think it is on sum insured, madam.
Let me check.
Add-on debris. As per tariff, it is on sum insured.
Okay, I'll just check.
And coming to architect fees add-on, how we will take the sum insured, madam? Means I am asking how to arrive sum insured.
See, you have to take a nominal sum insured. After all, the claim amount will decide, but normally, see, this is a tariff is of 2001. If you ask me for practical purposes, nowadays, if we go to the normal products and all, 5 crore is opted by almost everyone whenever they are having high sum insured. So there, that factor of claim amount and whether it's the sum insured, total sum insured percentage is not applicable anymore. But for our understanding, I'll just check. See, I have the screen. If you can see it, it's still here. They have given 1% of claim amount. This is a tariff page I'm opening.
I'm talking about add-on, madam.
Hmm. These are also add-on provision.
Inbuilt is
Yeah,
on claim amount.
excess of 1% of claim amount only. Add-on cover. Removal of debris. Okay, yeah, 10% of sum insured. Yeah, you're right. I'll just make the correction in the slide. It's maximum up to 10% of sum insured.
Yeah. But one more regarding spontaneous combustion add-on.
Huh.
You mentioned only fire damage as a result of spontaneous combustion. What may be other damages, madam?
Actually, I've not come across any of the study material which is, mentioning any other kind of damage, but that's why it is specifically mentioned only fire damages. But I'll just find out and I'll get back to you, sir.
Yeah, ma'am. Thank you. That's all.
Thank you, sir. Anyone else?
Okay, ma'am, we can end the session now.
Okay. Thank you, Rishikesh. Thank you, everyone. All the best. Give your best and
Madam, one more
yeah,
question was there.
yeah, yes, sir.
Can you give us an example of fire and shock, earthquake, fire and shock?
See, it's the same meaning. Only thing is those words are written. Fire and shock.
Okay, okay.
Concept is same. Only the term is mentioned as fire and shock in the policy document.
Okay, okay.
Rishikesh, should I stop the? Hello. Hello, Rishikesh. Yeah, I think.
Yes, ma'am.
Yeah, yeah. Yes, ma'am.
In the current slide, the debris removal,
Uh,
it is inbuilt in excess of, inbuilt is 1%, right?
Yeah, 1% and
So
excess of.
it's like in excess of 3%. So there will be some 2% gap.
1 second.
The current slide, whatever you're showing now.
It's okay, 3%, 1% should be. Yeah, that's it. I'm just correcting it and then I'll be sharing the PPT.
It is excess of 1% up to 10%, right?
Yes.
Okay.
Thank you for pointing. Okay, I think we are done then. So all the best, everyone. I'll be sharing the notes. Rushikesh will be forwarding it to you, everyone.
Thank you, ma'am.
Yeah, thank you.